Hello everyone, welcome back to Brain Power Classes. This is our part 2 of class 12 economics chapter number 9, money market and capital market in India. So now we are going to start with commercial banks. So first of all, let's understand what commercial banks mean. So commercial banks are the banks that act as intermediaries in the financial system. This means they collect money from people who save and give that money as loans to people who need it. These banks are profit seeking institutions, so their main objective is to earn profit. The two primary functions of commercial banks are accepting deposits and giving loans and advances. So remember this, two primary functions of commercial banks. First, accepting deposits. Second, giving loans and advances. Commercial banks also play an important role in collecting savings from people and providing funds to different sectors of the economy. On the basis of, you can see here, on the basis of ownership and functions of commercial banks in India are divided into four categories. First, public sector banks. Second, private sector banks. Third, regional rural banks. And fourth, foreign banks. Now, popular definitions of commercial bank. According to uh, according to the Banking Regulation Act 1949, banking means accepting deposits from the public for lending or investment, and these deposits can be withdrawn by check, demand draft, or other methods. And another definition, according to Professor Kern Cross, a bank is simply a financial intermediary or a dealer in loans and debts. So these were two popular definitions given. First one is given by Banking Regulation Act of 1949, and other one is Professor Kern Cross. Now, what are the functions of commercial banks? First, first main function is acceptance of deposits. So acceptance of deposits. The first and most important function is accepting deposits. Deposits are the main source of funds for commercial banks. People save money and these savings become deposits in the bank. So deposits are divided into two types: demand deposits and time deposits. So demand deposits are those deposits that can be withdrawn at any time. They include current account and saving account. So current account is generally opened by a businessman, companies, or industries, and through because and trust. So because they make frequent transactions. These accounts also provide an overdraft facility, which means the customer can withdraw more money than the available balance. And another is savings account, is mainly opened by salaried people and small traders who want to save a part of their income. Now, in the second is time deposits in that. So time deposits are those deposits that can be withdrawn only after a fixed period. There are of two types: recurring deposits RD and fixed deposits FD. So in a recurring deposit, the customer deposits a fixed amount regularly, usually even month or for a specific period. And in a fixed deposit, the customer deposits one lump sum amount for a fixed period. Since the money remains with the bank, remain the bank for a since the money remains with the bank for a longer time, fixed deposits provide a higher rate of interest compared to other deposits. Second is providing loans and advances. This is the second important function. So commercial banks use the money collected from deposits to provide loans to individual and institutions for different purposes. Depending on the time period, loans are of four types: call loans, short loans, medium term loans, or long term loans. Generally, the longer the loan period, the higher the rate of interest. So apart from loans, banks also provide cash credit, overdraft facility, discounting of bill of exchange, this that all. Now, third function is ancillary function. So, apart from their main functions, commercial banks also provide many additional sources called ancillary functions. So, what are the functions? Transfer of funds, collection of money, making payments on a behalf of customers, merchant banking, foreign exchange services, safe deposit like deposit lockers, demand facility, internet banking, mobility, mobile banking, etc. Now, next is credit creation. Another important function is credit creation. Now, commercial banks are called creators of credit. How? So, first, banks collect deposits from customers. After keeping the required reserve with the RBI, the remaining amount is given as loans. So, when a bank gives a loan, the loan amount is deposited into the customer's bank account. The bank receiving this deposit again keeps the required reserves and lends the remaining amount. This process continues throughout the banking system and creating new deposits from loans. This process is called credit creation. So these were the commercial bank functions. Now next we have cooperative banks. So let's understand what is cooperative banks. So cooperative banks came into existence after the Cooperative Credit Societies Act 904. Their main purpose is to support commercial banks by providing loans to the local population, especially people belonging to small and medium income groups. So the cooperative credit structure in India has three levels. You can see here the three-tier cooperative credit structure. So at the state level, there is a state cooperative bank which is also called the Apex Bank, and at the middle, at the district level, there is a district central cooperative bank, and at the primary level, there are primary cooperative credit societies which directly serve people in villages and local areas. Next, we have development financial institutions, DFIS. So these development financial institutions provide medium term and long term financial assistance. They support the development of important sectors such as industry, agriculture, infrastructure. The first development financial institution in India was IFCI, established in 1948. You can see here. After the liberalization and globalization, DFIs started offering many new financial services like commercial banking, consumer finance, venture capital, infrastructure finance, broking, e-commerce services, etc. So, because of these changes, many DFIs have become universal banks. A good example is ICICI, which later became uh, ICICI Bank. Next, we have Discount and Finance House of India, DFHI. The Discount and Finance House of India, or DFHI, was established in 1988 on the recommendation of Waghul Committee. So it is jointly owned by the RBI, public sector banks, and financial institutions. Its main objective is to provide liquidity to money market instruments, making the money market more efficient. Next, we have unorganized sector. So now let's study the unorganized money market. This sector mainly operates in rural areas and includes three important institutions that we are going to learn now. So first is indigenous bankers. Indigenous bankers work similarly to banks. They mainly provide short-term loans using traditional credit instruments like hundi. So they are important source of finance in areas where banking facilities are limited. Second is money lenders. Money lenders mostly operate in villages. They generally charge a high rate of interest. A high rate of interest. People like agricultural laborers, small farmers, artisans, and small traders usually borrow money from them. Today, the RBI has restricted many of their activities because of their exploitative practice. Next, we have unregulated, that third is unregulated non-bank financial intermediaries. These include cheat funds, nidhi, loan companies. So, in cheat funds, members contribute money regularly and the collected amount is given to one selected member according to agreed rules. Nidhi is also a mutual benefit fund where members contribute money and receive loans to reasonable interest rates. And last one is our in these loan companies. You can see here. So this each we are learning. So in this last one is loan companies. So loan companies provide loans mainly to traders, small industries and self-employed people. Since they are unregulated, they usually charge a higher rate of interest. Now, role of money market in India. So in we are not going to list this, but in short I will explain you all. So just I will go through once it. So first is short term requirements of borrowers, liquidity management, portfolio management, equilibrating mechanism, financial requirement of the government, implementation of monetary policy, economizes the use of cash and growth of commerce, industry and trade. So see what I am explaining now. So role of money market in India. It helps borrowers meet their short-term financial requirements. It helps in liquidity management, ensuring smooth flow of money in the economy. It provides different financial instruments, helping investors in portfolio management by reducing risk and concerning returns. It maintains a balance between the demand and supply of short-term funds. It helps the government meet its short-term financial needs through treasury bills called T-bills. Next is it supports the RBI in the implementation of monetary policy and helps maintain a proper interest rate policy. 7. It reduces the use of physical cash by promoting the financial instruments instead of actual money. And last one is it finally it supports the growth of commerce, industry, agriculture and trade by providing easy access to short-term finance. So in next video we will be going from or we will be learning from problems of the Indian money market and further. Till then, thank you everyone. Keep learning and keep going with brain power classes. See you in next video. Bye.